I talk about silver, and we are up at a gold silver ratio of about 90 to 1. And I'm expecting it to go to like 10 to 1. In other words, if gold rises 200% or 300%, you can take that times 9 would be the performance of silver. I said it in the video that I really think that anybody buying ETFs, if they think they're buying real gold and silver on their brokerage platform, I think they're fools.
The borrowing fee on SLV ETF has just gone vertical, up 10x since this morning. 10x.
Wow. Wow. And look at that green bar at the end. Unbelievable.
It dwarfs the entire chart. You can't even see what was happening before that because the move today was so humongous. But yeah, big moves are happening in the gold market and the silver market, actually. So I want to share some things about deliveries, lease rates, just buying volumes. Things are moving big time. Frankly, I think they're out of gold. So yeah.
Right. And that is pretty much the theme of the previous video, is showing that there is a real tightness in this market right now. However, the tightness isn't, the general public, the small retail investor has sort of been sleeping this whole time. The big smart money is awake. And so what they're buying is the stuff off the commodities exchange. And what we did was we took the lowest price of gold after its 1980 high to today. What was the lowest price? It was $253 in 1989. So the blue line is the 70s bull market, the entire thing from the lowest price to the high of 873 in January of 1980. And then we took the current bull market starting at in 1999 to today, and that first wave up where they both hit a high. I just had you line up the lows and the highs. So we had to take the current bull market and squeeze it, and then squeeze it this way to get those to line up, just to see. And the correlation, we're going, oh my God, we could not believe the correlation between these two. It was just astounding. Every time I hear somebody go, oh yeah, $50 silver, that's when the Hunt brothers cornered the market on silver. Everybody that says that does not know what they're talking about. I believe because gold was in a runaway. This was my theory, that the Hunt brothers were used as the scapegoats to cap the price of gold to save the US dollar. People have no idea how close we came to losing the dollar.
This analysis connects a critical market lie to today's unfolding physical crisis. The 1980 Hunt brothers corner was a myth. Evidence suggests they were scapegoats in a government operation to cap gold and save the dollar through manipulated rule changes. This historical manipulation reveals a playbook of controlling prices through paper markets. Today, that control is breaking. Real-time data exposes a severe physical shortage. Silver ETF borrowing fees spiked 10 times in a single day. Gold lease rates soared above 5%. And COMEX deliveries hit record levels as billions in bullion are withdrawn.
While stock markets slowly claw their way back to previous highs, gold, silver, commodities, energy, oil massively outperform, rising hundreds and in some cases thousands of percent.
Wow. These things sometimes can be self-fulfilling too, where enough people see this, and so this is going around, and it causes them to get worried, and they sell, and it begins. So yeah. So what was the size of that crash in 2008?
Well, we were at about 14,000 on the Dow, and it went down to about 7,000. So it got cut in half, 50%.
There's your 50%, just like it said in the rotation that they were talking about.
Yes, exactly. So if that were to happen today, we're around 44,000, that could go down to 22,000, 50% over the span of maybe a year and a half, 2 years.
People have no idea how close we came to losing the dollar back in January 1980, because lines were developing all over the world all over the world, really North America and Western Europe, because that was the only place like it was illegal and available, and it was and there were exchanges that would affect the price. So it was roughly 10% of the world's population. Today, it's 100%, 18 times more people when you consider the population growth.
It is possible.
Silly. Anybody talking about $9,000 gold is considered a lunatic. But if you went back to the beginning of this century when gold was 250 and said that gold was going to be 2,500, it was going to go up tenfold, you would have been called a lunatic then. So, because it had been going down. Everybody was saying, I was saying, you got to look at gold. And everybody goes, gold, it's been going down for 20 years. And I'd say, exactly. Where they said that Drexel Burnham was a brokerage house that went under back in, I think, 1990s. And they had a bunch of gold that was leased from the Bank of England that was lost. It never got returned. And it said that this is the dirty secret of central bank vulnerability, that they lease gold, and we have an unstable system, so they can lose their gold reserves with all of this gold leasing and rehypothecation that goes on. But this is insane. Look at the size of that spike, up to over 5%.
The system is so strained it's melting ancient 400-ounce central bank bars to meet demand. This signals a historic capital rotation from inflated financial assets into scarce hard assets. The conclusion is urgent. The paper market facade is collapsing. This isn't a repeat of 1980. It's a larger systemic failure where physical possession is paramount, setting the stage for a revaluation of gold towards $9,000 plus and silver to dramatically outperform as the gold to silver ratio plummets from 90 to 1 to 10 to 1. Subscribe to Fine Metals for future updates.
And the gold market being about 300 times the size of the silver market, back then at least, or maybe that was when I wrote my first book. It was 300 times the size. I don't know what it was in 1980, but the silver market is much, much smaller, therefore much easier to manipulate. So if they could make in gold, there was no concentrated position like there was in the silver market with the Hunt brothers. So with the silver market, they could intervene and make an example of the Hunt brothers and use them as a scapegoat to cap the price of gold, because a lot of silver traders are also invested in gold, and because in the old-fashioned pits on the floor, the trading floor, where it's a circle of guys screaming at each other and doing hand signals, the silver pit is right next to the gold pit.
I want to show everyone is this. Basically, what we're looking at here is the percent return you would get vertically. Okay, so however high you are on this chart is the percent return you'd expect. So higher is better. And going across the bottom here is risk, which we're measuring by volatility. So like the standard deviation of the returns in a portfolio.
And so the volatility, is the choppiness of the price and the magnitudes of the drawdowns. And so this is interesting. This is from CPM Group. And CPM, they tend to be very conservative. Their numbers are accurate. And this goes all the way back to 1968 to 2020. So they're taking a 60-40 portfolio of stocks and T-bills, which is the standard recommendation. And then they're keeping, they're adding gold and keeping the remainder of it 60-40 stocks and T-bills. And what's interesting is 20 to 30% is incredibly low risk, but incredibly high return. If you want to take a little bit more risk and be able to ride out the roller coaster of the bumps and dips, then this is showing that the higher you go with gold, the better your return has been from 1968 to today. This is what I've been waiting for a long time. I mean, I've done spectacular because I started buying at $315 an ounce gold. So I've done very, very well over the years. But the best is yet to come.
I agree. Get your hands on gold and silver. Keep calm, but all the gold and silver is gone. Oh no.
Yep. That is, these are the types of bars that were in Fort Knox when there was the gold nationalization in 1933 and so on. They are a remnant of international gold standards, where either the Federal Reserve in New York or the Bank of England were the hub, and there was pallets of gold in the basement, and they're constantly doing settlement between countries. So this is not your normal public gold that's traded on exchanges. They're dipping into something that is strictly central bank gold. It's being loaned out. It's going to Switzerland. It comes back as 100-ounce bars and kilo bars that can be delivered into a futures contract. And so this just shows the desperateness of what's going on. If they're out of all of like the normally traded consumer gold, and they've got to dip into this ancient central bank gold. And I used to joke, I'd say, you look like a $5,000 an ounce guy. And they'd say, what? You're going to wait until gold is $5,000 an ounce before you buy. And there are people like that. They're in the stock market. They're just stuck with it, and they're going to lose 50%, and then they're going to buy $5,000 gold in that rotation, that capital rotation that you were talking about. So
yeah. There's a saying in the Bitcoin community that I think applies to gold and silver. It's everyone buys Bitcoin at the price they deserve, and everyone buys gold at the price they deserve. Everyone buys silver at the price they deserve. That's it, So, anyways, all right, let's keep moving here. CME gold deliveries. This is a fascinating chart here. Do you want to talk about this one, Mike?
Well, Nick Laird at Gold Charts R Us sent these out in an email, and I saw this and I went, oh my God. Because the thing that is amazing is that those other two big spikes during the COVID panic right there, those are the highest spikes on record, but that's for entire months. And this recent spike is for the first 5 days of this month. Just 5 days, and we're already higher than the second highest spike in history of gold deliveries. And this is the problem. This is the reason for the emergency. This is the reason people are that the Bank of England is selling those 400 or loaning out those 400-ounce bars at a discount to spot, because people are paying $50 to send them to Switzerland and get them refined into. And I would imagine Switzerland is way backed up at all their refineries right now to melt down these 400-ounce bars, refine them into 100-ounce bars and kilo bars, so that the COMEX can continue their deliveries without a force majeure, without running out and saying cash settlement only, which would cause gold to just like I would feel that it would almost instantly double in price. There would be a scramble around the world for gold if that happened. It's probably not going to happen. They patched it up last time. They somehow kept the music playing. Well, everybody is dancing around thinking that they can, in the musical chairs, that they've got a seat, when there's actually only one seat for every 10, 20, 50, 100 people dancing. And so this exposes all of the vulnerabilities when this stuff happens. But 5 days, that is an amazing spike.
The chart on the left here is base 5. The chart on the right is base 6 for anyone who's interested in the logarithms there. So a 20% increase is warranted. So what that would look like is a gain of 3.3x in just about 1 year, 355 days. And if you want to do the math on that, like where does that put us in terms of dollars per ounce? Well, 3.3 times today's price, 2,893. Just multiply that, and that's over 9,000. I'll tell you that much. Maybe like 9,400, maybe.
Okay, well, yeah, except for that extra stored energy and all the currency printing.
Yeah,
I don't know. Maybe I'm, but I see. When it went sideways during COVID, well, Bernanke created $4.2 trillion of base currency, and then that all went through Bernanke and Powell, basically, since then have created all of that. Not Bernanke. This is just Powell, but it ended up at 4.2 trillion of base currency. And that went into the stock markets. It created the bubbles. Then we mailed the checks to people, and we've had huge inflation. And so gold is just catching up here. The expansion of the currency supply has been absolutely enormous since the beginning. The red line starts in 1999. And so the expansion of the currency supply in fact, let me see. I'm going to just read there's a chapter that I believe is extremely important if anybody wants to know how high, if they want to know the fundamentals under this bull market compared to the bull market of the 70s. Since January of 1980, when gold peaked, there is now 18 times more people around the world that can legally buy and afford precious metals. There's 55 times more currency on the planet. There's 56 times more millionaires and 200 times more billionaires. But basically, those first two things, 18 times more people that can participate and 55 times more currency. That's all you have to know to realize that perhaps 9,000 is way low.
Yep.
So, yeah.
I totally agree. And this timeline here messes with my head more than anything else. Like, could this bull market really finish in 1 year? It doesn't feel like it to me. I feel like the bull market is going to go on a few years.
It all depends on what kind of crisis, what's going on right now could end up becoming a crisis that propels gold vertical like that. If we actually go into some sort of currency crisis or something, and then when you look at what they're doing, they are doing a lot of good things in this. They're doing some real house cleaning in the government. Elon Musk and Trump, but Trump doesn't really know economics that well. And if they do more cost cutting, then they unleash business, then they could cause a serious recession. And China is we are set up right now for a global recession. And these tariffs, if we get into trade wars and tariffs, that will cause it. That's one of the things that caused what should have, Milton Friedman said that the Great Depression should have just been a deep but short-lived recession.